Hello, 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 and happy Thursday. Welcome back to yet another live event where we unpack passive investing, multifamily underwriting, one step at a time. So, C-PACE financing is the topic I will cover today. I came across an interesting article and I'll share more about it in a moment. But before we get started, for those who don't know me yet or haven't met me yet, or perhaps are tuning in for the first time, my name is Vessi Kapulian, former commercial lender turned entrepreneur and real estate investor. And today I advise family offices and their family enterprises on risk mitigation, due diligence, strategy, M&A, and governance, transitions, next gen transitions. I also work with high achieving professionals looking to diversify their income streams and create tax efficiencies, and I help connect them to well vetted investments in apartments. And last but not least, I help investors, active or passive, navigate through the complexities of the deal offering, underwriting, and structure. And for those willing to do a deeper dive, I also have a self-paced course and community where they can literally learn how to underwrite a deal from A to Z in 5 easy steps to protect their capital and hard-earned monies and mitigate risks. So, without further ado, I thought I would cover today's topic regarding CPACE financing. There was an article in Globe Street that I came across earlier this week that literally talked about how institutional interest in the CPACE space is growing. And I'll cover what that is in a moment, and in a little bit more detail, we'll go through what CPACE financing is, how it is structured, where it falls in the capital stack, some of the nuances and risks to be aware of, both as an operator, if you're taking on CPACE financing, or as a passive investor evaluating a deal that has CPACE financing. But what I thought was interesting, not only the fact that institutionals are now more interested in the space, but also the fact that the um, uh, guidelines have been expanded a little bit more. But before we and I personally came across just in the last 12 months. Normally, it's been out there forever. This is not a new phenomenon, so to speak, but not one that has been very frequently utilized. Though in the past, call it 6 to 12 months or so, I came across a couple of deals that have utilized that type of financing. And so I thought it would be helpful to talk through what that is, the nuances. So if you do come across a deal that has that type of financing, or perhaps a situation that may be a good fit for CPACE financing, you can recognize the opportunity, proceed accordingly, and of course, underwrite it accordingly. So, what is CPACE financing? So, CPACE stands for Commercial Property Assessed Clean Energy, and it's a public private partnership financing mechanism that allows effectively commercial property owners to obtain long-term fixed rate capital for specifically for energy efficiency, renewable energy, certain water conservation or seismic updates. And again, it could be used for new builds, or if you're making additions or reconstruction to the property. What's unique about it is that the financing is actually repaid through a special tax assessment on the property, and that this financing is tied to the property and not necessarily the owner of the property, which means it can carry over to the next owner. And I'll come back to that in a second. The terms are very generous, typically around 25-year is the term, and amort. And really, The exact number would depend on the useful life of the improvements that you're making to the property. And again, can be used for brand new construction, like I said, refinancing, qualifying improvements, or retrofits. I did mention special tax assessment and private-public partnerships. So there are three key parties involved in this type of financing. One is the property owner, then the capital provider, which is typically a private lender or could be a specialized specialty CPACE provider, and then of course the local government administrator. So the capital provider will fund the project, but the government administrator will be the one who would levy the special assessment that is attached to the taxes, and that effectively becomes the repayment mechanism. It is recorded as a voluntary tax assessment lien, and because typically taxes are paid either on a semi-annual or annual basis, depending on the county that you're in, that's when the payment will take place versus a traditional loan, right? You pay your principal and interest, or at least your interest, on a monthly basis. So there's a little bit more flexibility there. Also, the payments are non-accelerating, meaning if, God forbid, you're in a financial disaster situation, only the past due payments are owed. Is what is owed versus the full amount of the financing, again, because it follows the property and not the owner. Because of that, it is important to recognize that because it is part of the tax payment, in terms of seniority, it will rank ahead of the senior mortgage. And because of that, when you work with a lender, typically they would want to take a few steps to protect themselves. First of all, they will want to they may want to include a non-acceleration covenant from the CPACE issuer. They may want to obtain confirmation in writing that the CPACE runs with the property and not with the borrower, and maybe additional documents that they're not going to take any foreclosure, go after the full amount. They may escrow that additional amount. Typically, right, they escrow for taxes and insurance. So since this is part of the tax bill, the escrow amount will be larger. And in essence, then that's how the lender would get comfortable, right? Because if, God forbid, you get into trouble, they've escrowed the amount, they can make it current with the CPACE lender, and then take over the property and go their merry, or maybe not so merry ways. They may want to include caps on the annual payments due to the CPACE lender. And again, since it is part of the tax payment, this will directly flow to NOI, which is what's used to calculate the debt service cover covenant. But if for any reason it is not reflected there, which is kind of unusual, but if it's not, they may want to also bake it as part of the debt service coverage definition, just to mitigate some of the seniority risk that I just mentioned. And last but not least, to avoid double financing, they will definitely want confirmation in writing of what exactly the CPACE will be financing, especially if you're in a situation where you maybe also are applying for construction or some sort of bridge financing that the lender is also providing financing for. So that will definitely need to be clearly documented to avoid a double financing issue. So in terms of seniority, like I said, it ranks before the senior debt, although the senior lender would typically take the steps that I just went through to mitigate that risk. And it becomes a very valuable tool that can fill a gap that otherwise would be filled by preferred equity, which we're seeing a lot of these days, or maybe mezz debt, or maybe even higher cost of construction financing, right? If it covers all the construction or rehab needs that you need, again, related to energy efficiency and environmental conservation, renewable energy, and so forth. If that's all you're doing, it can potentially eliminate the need for construction financing. And so it's ahead of the senior lender in terms of seniority, but economically it's behind because again they cannot accelerate the full amount of the CPACE financing, only the amount that is past due. It is a fixed operating expense that will be baked in the underwriting. Again, you want to make sure that especially the tax estimates are adjusted accordingly. And of course, to be aware of, because it is not free money, right? It is debt after all. It increases the leverage profile of the property. Of course, that amplifies the returns, but high returns also mean higher risk, so something to be aware of. And it's also lower cost of capital versus what you would otherwise obtain from a pref equity partner or a mezz lender, or potentially higher cost construction financing. But it is not for free, and probably will cost a little bit more than your traditional bank financing. So you may ask, well, if it is the best thing that happened since sliced bread, why are not more people doing it? Well, you have to qualify for it. First of all, it's for commercial property, multifamily will 5+ units will qualify for it. Um, Property owners or developers who don't have any who are in good standing, don't have any prior delinquencies, no code violation, they have clear title, the lender, of course, consents to it. And of course, the property must be located in a state and county that actually has the CPACE legislation implemented. Again, remember the three parties that I mentioned at the beginning of the call. So it may not even be available where the property is located. And last but not least, the uses must be related to energy efficiency, whether that's HVACs, windows, insulation, renewable energy like solar panels, and water conservation, seismic strengthening, very relevant here in California, storm resilience or flood mitigation, maybe fire protective measures. And in some states, particularly where retroactive improvements may be even required, you could utilize that type of financing up to, I think it's 1 or 3 years. Definitely check with the lender though after the project was completed. Because of all of that, there are additional steps you may have to take, and it also may take additional time to put that financing in place. So, in addition to all the traditional due diligence reports that the operator will do and that the lender would require prior to providing financing for the property, you may also need to perform an energy audit or a special engineering report that will actually demonstrate the savings. You may have to engage a third party review to actually validate the eligible costs that will be financed. Of course, you need to obtain the municipal approval from the program administrator. Like I said, the lender consent, and of course, title review to ensure that everything is clear. And in some states, like California is a famous one, specifically wage requirements. So that it may take a little bit longer, right? Typically for financing, you may budget around 60 days. In the current environment, maybe even 90, but it's not uncommon for that to take a little longer, maybe even 120 days. And because they work hand in hand with your primary lender, that may delay the closing of your loan, and therefore you need to account for a longer closing period. So when you structure the PSA with the seller, it's important um, to factor that in accordingly. There are additional fees, of course, associated with that. Not uncommon, but like origination fee, program administrator fee, annual servicing fee, of course, the additional reports that I just mentioned, and of course, additional legal fees to document all of that. And so it has a lot of pros, and I mentioned those as far as the more flexible finance terms, as far as repayment period, frequency of payments, and how those get levied. It's and fixed rate and all of that, but there are also a few cons to be aware of. I already mentioned some of them, which is the higher leverage. Secondly, the longer periods, higher costs. Although when you do the ROI benefits and cost analysis, it should become pretty clear, right? Is it a go or no go? And then it follows the property. So when you're underwriting a deal that has CPACE financing, you definitely want to make sure that the taxes reflect the repayment of the CPACE loan. So your traditional tax estimate will need to be increased, right? Because you'll be including that voluntary tax assessment. And secondly, run different sensitivity scenarios because, again, that financing is attached to the property, not to the owner of the property. And so the new owner that you're selling the property to 5-6 years down the road, um, they may not want to accept the assessment, or they may ask for a discount, right? Especially if they're not familiar with the CPACE program. So there may be some exit complications there. And of course, we want to make sure you account for the escrowed amount that will be higher, right? That the lender will most likely be asking you for. And if they're not, for any strange reason, then factor, like I said, an additional tax assessment in your pro forma debt service coverage ratio, and make sure the definition is crystal clear between you and the lender on how that will be measured in case they want to modify the standard definition there. So I hope that was helpful. Of course, if you have any questions, feel free to reach out. And I almost forgot. I don't know how I forgot, but December 14th is the big reveal. I have something very, very special to share with you. 10 a.m. Pacific. I will be going live on LinkedIn as well as YouTube. I've been posting the links, but in case you're tuning in for the first time and maybe seeing me for the first time, I will make sure I post them in the comment section below of this live event. And that's it. I wish you a blessed Thursday. I will see you on Sunday morning where I have something amazing to share with you. I've been working on this project for a really long time, and it was designed to help the active and the passive investor. There will be a ton of bonuses and additional gifts that I will be sharing on this special date, so you don't want to miss it. And I wish you a blessed Friday, Saturday, and I will see you on Sunday. Ciao.